Swayam Prabha. Digital India. Educated India.
Hi all, welcome to this session on commodity derivatives and risk management. And today we are going to discuss about the pricing and valuation of commodity forward and futures contract. And let me start this session by asking a question to all of you. What is the difference between value and price? How many of you will be able to tell what is the difference between price and value? Okay, let me give an example which will clarify this very basic yet important understanding. Let's say you go and buy a company share from the stock market at a price prevailing, let's say 180 rupees, and your order got executed around 11 o'clock in the morning. So you bought the company share by paying 180 rupees. So that is the price. Let's say there is no change in the price for, let's say, coming another half an hour, 45 minutes. And in the meantime, the value of your investment has remained unchanged. So there is no value for you, or your value of the investment is zero. Let's say after half an hour, some positive news about the company comes and price increases to 220. So sometime in the afternoon, when you sold the share at 220 rupees. So when you sold that one, or when the share is quoting at 220, the value of your investment is now 40 rupees. So you bought the share at 180 rupees, and maybe an hour or two later the price has increased, and in that case the value of your investment is positive 40. And let's say some bad news about the economy happens or comes, and the market reacts negatively, and your share price goes down to, let's say, 120. And of course, I am assuming there is no circuit breaker for this company. With respect to circuit breaker, stock exchanges allow what is the maximum amount of daily variation in a share price can happen. Let's assume that this company does not have a stock circuit breaker associated with it, and price falls to 120. In that case, the value of your investment is negative 60. Now today, as I had mentioned, that we will be discussing different aspects of pricing and valuation of commodity forwards and futures contract. Now all commodity derivative contracts or any derivative contract derives its price from the price of the underlying asset, that is in this case the commodity. So we must have information related to spot price. So what is the spot price prevailing today? So that is going to be one of the important parameter, or the most important parameter for pricing our derivative contract. Now you know that commodities trade almost all places. So let me give an example. Like if you go and ask buy a packet of sugar, you go to your neighborhood shop, and each of you, whoever is seeing this video, if you go and if you ask the price, I'm sure each of you will be getting a different price depending upon the where are you, whether you are a rural town or whether you are a big shopping mall, or depending upon which state, you may end up paying a different price. Now when we are talking about the spot price, so which price are we going to consider? Considering this spot price for a commodity can vary significantly from place to place. Now exchanges collate the spot price information pertaining to a particular commodity from the major trading center for that particular commodity. And this major trading center normally happens to be the basis center for delivery, which is mentioned in the commodity contract specification. Now let me take you to this particular link file. It is the sugar M grade, medium grade sugar. I hope you are able to see the left column. So this is your Now the sugar M grade price, that medium grade sugar price at Kolhapur on the polling which has been taken on 27th May at 3:10 p.m. So this is 3,578.75, and also around same time in the afternoon, the National Commodity Derivative Exchange has conducted a poll among major market participants to find out the price at which they are buying and selling sugar in the respective market. So you have Kanpur, Erode, Muzaffarnagar, Delhi, Kolkata, and if you can see as clearly visible, the price at Kolkata is 3,720 rupees per quintal, and at Kolhapur it is 3,578.75. So the exchanges take the responsibility of collating this information, and by conducting poll and informing this or letting this information made available in the exchange, commodity exchange, so that derivative traders, futures and options trader are able to use this information for pricing the derivative contracts. Now, as I have mentioned, this the polling which is conducted by the commodity exchange is not only for the major market, spot market. They also do the polling for the additional delivery centers, the basis center and the additional delivery center, which is mentioned in the contract specification. So if you recall, in the sugar M grade futures contract at NCDEX has Kolhapur and Kolhapur as the basis center, and Belgaum, Erode, Delhi, Kolkata, Pune, Sangli, etc. as the additional delivery center. If you do not recall the contract specification for the sugar M grade, I'll advise you to go to NCDEX website and download the contract specification for sugar M grade. Now, how exactly the polling is done, what is the mechanism followed by the commodity exchange to poll, who are the market participants. So all this information is very clearly elaborated or made available by the exchange. So this is the document which is NCDEX spot polling mechanism is the complete detail of the polling mechanism is mentioned here, and this is an interesting document. So you do spend time to read this and how price tracking is done and all interesting important information pertaining to calculation of spot price. polled spot price, I should not say spot price, calculation of polled spot price is very clearly mentioned. And this is a very important requirement, because unless traders know what is the prevailing spot price, they will not be able to price the derivative contracts. Now let's I'll take you to the, so this is the, I hope you are able to see this screen. Let me increase the screen size. Yes, this is the live futures quote at NCDEX. Market is currently on right now. If you can see this, this is a barley contract, the contract which is maturing on 20th July 2016, barley 19 August 2016. So this is the nearby contract. This is the mid-month contract. This is the contract maturing on September and October. And if you see, this is the future price, open, high, low, close, etc. And you have a change compared to the previous day, percentage change, average trading price. So throughout the day, the average price at which this barley contract has traded. And please see this one, this is 1625.7. this is the polled spot price which has been collected by the National Commodity and Derivative Exchange and has been made available to the traders. Similarly, you have chana, this 8152.1, and different for all derivative contracts. They are making available, or NCDEX is making available the spot price. Okay, now let's continue with our Now, before we go to the discussion on how do we value forward contract or futures contract with respect to commodity underlying, let's focus our discussion little bit too on what is a investment asset and what is a consumption asset. Okay, let me ask you a question. If I ask you to elaborate what are your financial assets, your or your family members' financial asset, you will probably mention bank fixed deposit, some insurance policy, public provident fund, some equity investment, mutual funds, maybe some debentures, and real estate. So these are your investment assets, which are financial investment asset. And under the commodities, again, commodities can be categorized as investment asset and consumption asset. So which are investment assets? Commodities which are primarily held for investment purpose, such as gold and silver. Of course, in Indian context, maybe many people may not be holding silver as an investment commodity. However, of late, many people have started investing in exchange traded funds of silver to make profit from the movement of the silver price. So gold always has been an investment asset. Most of the people hold gold either in jewelry form or bar or gold form for getting some return out of it. And another commodity which is getting a lot of attention of late, of course not in Indian context but in international context, as far as it being considered as a investment asset, is the crude oil. So now many hedge funds and exchange traded funds are investing in crude oil to make profit out of this crude oil. So crude oil is also being considered as another investment asset. In the Western market context, not in Indian context, not many people hold warehouse receipts of crude oil and try to make profit out of the price movement of the crude oil. in this context of hedge fund money or exchange traded fund investment going to crude oil, a new term is being coined, that is called financialization of commodities. So when a lot of investment money flows to a particular commodity, this commodity tend to exhibit significant amount of volatility, and a lot of research, a lot of debate also is going on whether financialization of this commodity is leading to excess price volatility. Now let's go to our understanding of which is a consumption commodity. Consumption commodities are those commodities which are predominantly held for the consumption purpose, like your wheat, aluminium, coffee, rubber, steel, all these are your consumption commodities. Now when we go and talk about pricing of forward and futures contract for financial asset, we use a model called cost of carry model. So what exactly is a cost of carry model? Let us focus on what is the brief understanding of a cost of carry model. Let's say a trader who is interested to buy a commodity or a financial asset. It could be any asset. Let me put it, instead of commodity, let me make it any asset. A trader wants to buy an asset at a later point of time, let's say after 6 months. So what are the options he has? He has two options in his hand. He can enter into a forward or a futures contract, or he can buy the asset. Let me again change this one to, he can buy the asset now and carry it till 6 months. So he has two options. He can enter into a forward contract, that is long forward contract or long futures contract, so that he will have the underlying asset with him after 6 months, or as part of option 2, he can buy the asset today and carry it till 6 months. So he would incur, any option he chooses, his cost is going to be the same in both options. So this cost of carry model proposes that a forward or futures contract is going to be priced based on the cost of carry model. So what is exactly? So forward or futures price, forward or futures contract should be priced as per the cost of carry model. So that, what is the carrying cost? Carrying cost is the cost of buying the commodity and holding it till the maturity or the 6 months, 6 months in this case. So what is the total cost involved? That is going to be equal to the forward price or future price the trader is going to quote. So in case of regular financial asset, you have a foregone interest cost, and also in case of a commodities you have storage cost. In case of financial asset, you do not have a storage cost associated with it, but in case of your commodities, there is some storage cost associated. Now let's take some numerical example to understand how this cost of carry model is calculated using both financial underlying as well as commodity underlying. Okay, now so what is the let's go to our understanding of this forward or futures price. So let's start with our understanding of how forward or futures price can be calculated when the underlying is a financial asset and financial asset does not have any cash flow during the life of the contract. Let's say today you want to buy a financial asset. Let me rephrase. Suppose we want to buy a financial asset 6 months from now, and today we have to quote a price. So what should be the price? And during this 6 months we are not expecting any cash flow out of this particular investment if we choose not to go for the futures contract, but we go for option 2, that is buying the underlying asset and holding it till the 6 month. So the forward price is going to be nothing but your F0 into the forward price or future price F0t will be equal to S0 into e to the power RT. And what is our R? R is your continuous compounded interest rate. And what is your T? T is your time period. So if T is 6 months, T value will be 6 months will be equal to 1 by 2, which is 0.5. At this juncture, let's discuss a little bit on continuous compounding. Okay, let me ask a question. If you go to a bank and make a fixed deposit, banks gives you two options. One is taking a bank will give you 10% interest compounded annually, and in option 2 bank will give you 10% interest compounded semi-annually. Which one will you prefer? It's a basic, very basic finance concept, and it's taught in the corporate finance time value of money, and we will quickly take some numerical examples to see how we can convert a interest rate with different compounding frequency to continuous compounding rate. So if you see this particular slide, you have, let's say the bank says bank is going to give you 10% nominal interest rate. So interest rate is nominal interest rate, compounding frequency is 1%. What is going to be the effective interest rate? Effective interest rate is 10%. And what is the equivalent compounding interest, continuous compounding rate? That is coming to 9.531%. So if a bank says to you that I will give 10% annual compounding, is equivalent to bank saying that we will give you 9.531% as continuous compounding. Similarly, you have a nominal interest rate of 10%, different compounding frequency, and we have calculated the effective interest rate and the corresponding continuous compounding rate. And for valuation of futures and forwards, we will be using the continuous compounding rate because it makes our life easier in terms of we'll be able to find out the forward or futures price for any number of days. Did not necessarily for 6 months or 1 year. We can do it for 4 days, 5 days or 20 days, so on and so forth. Now let's go to, we started discussing about how do we go about pricing a forward or futures contract when the underlying is a financial asset. Now let's go to the second kind of a financial asset in which if a particular person buys the financial asset, he or she may get some dividend. He or she is going to get some dividend during the life of the contract. So how do we do it? How do you go about it? Let's see, this is the maturity. This is the spot date today. Maturity date is T, and during the life of the contract, that is at small t, this company or equity share, the holder of the equity share is going to get X rupees as dividend. So in that case, what is going to be the value of a forward or futures contract? So what is going to be the present value of the X? So present value of X will be X into e to the power minus RT, which is equal to your present value of X equal to X by e to the power RT. So we will be finding out the present value of X, and how do we adjust the forward price? So F0t is nothing but your S0 minus I into e to the power RT. That is, I is equal to your present value of the dividend, and this I is equal to this value. Now many a times when the underlying asset is an index, specifically a equity index, we do not when the underlying is a equity index, in that case we do not use the dividend amount, we calculate the dividend yield. Let's take this example. So when the financial asset has a yield, then the forward price is equal to S0 into e to the power r minus q to the power t. And what is this q? Q is the yield rate in percentage terms. So all these three forward prices or future price we are calculating, this is nothing but is called a F theoretical. So that should be the theoretical value of a forward contract. Now suppose in real life we are calculating the forward contract to be something, but the same contract is quoting at a different price in the market. So what is going to be our strategy? And we know from the basic principle of finance that if the same asset is being mispriced, we can it is quoting at a different price than the fundamental price, we will be able to undertake certain arbitrage benefit. So what is the basic principle of arbitrage? Arbitrage means riskless profit, and we undertake arbitrage by buying low and selling high. So what we calculated using these theoretical values, that is your spot price plus the carrying cost minus the carrying return. So this theoretical futures prices are going to be compared with the actual future price. Now if there is a difference, we can undertake cash and carry and reverse cash and we can undertake certain arbitrage opportunity. Now what exactly is this arbitrage opportunity? Let's quickly take some examples. Okay, let's say if this is the F actual, which we calculated F theoretical using our cost of carry model. In the market we are seeing another price. Suppose this is the X, we calculated X and we are finding out this value to be Y. This is quoted in the market at Y value. So what is going to be our strategy? So if Y is greater than X, we will be undertaking cash and carry arbitrage. So what is the cash and carry arbitrage? Basically it comes from this buying low and selling high. So where do we sell? This is the high price, so we will be selling here and we will be buying here. So what we will be doing, we will be undertaking certain transaction on day 0 and certain transaction on day t, that I will take example and elaborate. Now suppose the reverse happens. If F actual, which is quoting in the market, is less than F theoretical, we will have reverse cash and carry arbitrage. So the reverse cash and carry arbitrage will be calculated again by will be able to undertake reverse cash and carry arbitrage by doing certain transactions on day 0 as well as doing certain transactions in day t. So what are those transaction we will be undertaking? Let's go to the screen. And so if F actual is greater than F theoretical, we will be using cash and carry arbitrage. So what is the meaning of cash and carry? Cash and carry means I borrow the spot price, buy the underlying and simultaneously enter into a short forward contract. And on day t, what do? I deliver the underlying, I receive the F actual and I return S0 with interest. Similarly, If other way happens, that is F actual, the price prevailing in the market is less than F theoretical, that is the price which we are calculating, we can undertake the reverse cash and carry. So what is a reverse cash and carry? We will be selling the underlying at S0 and we will be lending the S0, the sales proceed of the spot price at a rate for a period which is equal to the maturity period of the forward contract, and simultaneously we will be entering into a long forward contract. F actual is less, so we will be buying the forward contract, and on the maturity date T we will receive S0 with interest. We will take delivery of the underlying from the forward contract and we will be paying F0 for as part of the forward contract. Now let me summarize what we discussed today. We started with our discussion on what is the difference between price and value, and we also discussed how futures price for financial assets can be calculated, and if the calculated price is different than the price which is prevailing at the market, it will give us an opportunity to undertake arbitrage. So if the actual price prevailing in the market is less than the price prevailing in the if the actual price is less than the theoretical price, we will undertake reverse cash and carry, and if the actual price is greater than the theoretical price or the calculated price, we will undertake cash and carry arbitrage. So with this I will end up this session. We will continue with the remaining part of the session in the next class. Again, looking forward to interacting with you all.